Yeah, and the US dollar is an extremely important topic because it does stem from debt. At the end of the day, every debt-soaked nation, regime, democracy, monarchy, you name it, again, going back throughout time immemorial, eventually you'll try to save the system by debasing the currency. And I've had a lot of debates with Brent Johnson, who I really respect, on the strong dollar thesis. But again, and I think the Fed is signaling loud and clear that they need a weaker dollar because America can't even afford a stronger dollar and higher interest rates. But I think the currency is the thing because the debt market is the thing, and that means the bond market is the thing. When you look at what's going on with the US dollar, there's the headline making topics of de-dollarization, and these are, since we weaponized the world reserve currency during the Putin sanctions just 2 years ago, myself, Grant Williams, Ronnie Sturfula, Jim Rickards, Andy Scheckman, all of us understood that this was a watershed moment. It didn't mean the dollar was going to die overnight. To Brent Johnson's point, it's still the best horse in the glue factory for a lot of reasons. It's still 80% or 85% of FX transactions. It still has the derivative markets, the Eurodollar markets, the SWIFT system. It's 80% of all trade settlements are in the US dollar. We never said the dollar was going to die overnight, but the speed at which the world is de-dollarizing is actually even faster than I thought 2 years ago. You can't deny that anymore. So the de-dollarization thing is fascinating, but that's not really the end of the dollar. The end of the dollar will come from the central bank, the Fed itself, and we can go into why that's happening. The other thing that's fascinating and not talked about enough is just last year in the oil markets, the petrodollar markets. It's not a coincidence that, when we decoupled from the gold-backed currency in '71, that Nixon and Kissinger were running around in the Middle East trying to make sure that the OPEC nations bought our oil and made it bought in US dollars. That created a natural global demand for an otherwise unchaperoned paper fiat dollar. And for over 50 years, the world has been forced to buy oil in US dollars. That creates tremendous demand and strength for an otherwise debased and inflated currency. But what happened in 2023, which again isn't talked about enough, is 20% of global oil was sold outside the US dollar. That has extraordinary implications which haven't played out. And Saudi Arabia and the UAE are still pegged to the dollar, but so they don't want to see the dollar tank yet. But unlike Libya or unlike Iraq, and we know what happened to Gaddafi and Saddam Hussein when they tried to sell oil outside the US dollar, whether it was in gold or euros, well, they disappeared off the face of the earth. The Crown Prince of Saudi Arabia is not as worried, and Russia and China are not as worried as Libya and as Libya and Iraq were just not too long ago. There is a seismic tectonic shift happening in the petrodollar market, which affects the US dollar. That would be absolutely devastating. But what we're seeing in the GCC or the Gulf states is they're importing gold at record levels out of Switzerland this year, 2024. It's at record highs. I think what the Gulf states are doing slowly but surely is de-dollarizing, and they're going to slowly and surely sell more and more oil outside of the US dollar and net settle it in precious metals like gold. Again, this isn't sensational. This is happening. It's not making the headlines. These have massive, massive implications on the US dollar. So between the de-dollarization, between the oil trade, which is changing dramatically, and the fact that Russia can sell oil to China, China can pay for that, or Russia can sell it and take Chinese yuan and then convert that yuan to gold on the Shanghai Gold Exchange. There's all kinds of ways they can get around the petrodollar, and that genie doesn't go back in the bottle now. But in addition to these massive changes, the other thing that's tremendously headwind for the US dollar and proof to me that it's going to be continually debased is the level of US treasuries being issued right now is simply grotesque, and there's no foreign buyers for them. There's been net sellers of US treasuries since 2014, but the number of central banks that are dumping US treasuries and stacking physical gold in the last few years is simply unprecedented. And it's a warning sign. I've used the analogy, if you see an army marching towards your border and you see the cavalry and you see the picket lines and you see the scouts marching towards your border, that usually means something's changing, something's coming, it's time to be defensive. When you see central banks dumping US treasuries at record levels and stacking physical gold, that's not a gold bug argument. That's a sign that the world is no longer trusting that world reserve currency, which was weaponized just 2 years ago. So there are undeniable things happening with the US dollar. But as I said, the real blame won't come from the BRICS. It won't come from Putin. It won't come from the sanctions. It won't come from little green men from Mars. It won't come from global warming. The real reason the dollar is getting weaker is America's over its head in debt, over its skis in debt, and it's printing money and debasing its currency behind the scenes. We don't have yet an actual pivot to lower rates, but we will. Powell said it, but I think he'll have to do it because there's too many trillions of dollars worth of debt that have to be repriced this year. And if they don't reduce rates, Uncle Sam can't afford it. That's the fiscal dominance argument. But the other obvious thing is we've been doing QE for the last 5 years, about 4 or 5 times in the last 5 years. We've been doing backdoor QE. We emptied out the Treasury general account. That was Yellen doing backdoor QE off the balance sheet that Powell didn't have to admit to. We took money from the reverse repo markets. We had the BTFP program that phased out in March. But we had trillions of backdoor QE. Then what's also happening now, which is not making the headlines, is this thing called the supplementary reserve ratios, which allow the Fed banks to basically use unlimited leverage to make unlimited purchases of U.S. treasuries because foreigners aren't buying our treasuries. And all that is QE by another name. It's the Fed banks, branch banks of the Fed, big banks, are basically going to be able to buy all the U.S. treasuries that Uncle Sam can issue because no one else wants them. So that just makes it's just off the balance sheet QE by another name. And frankly, the most telling sign, which again isn't discussed, it's boring, it's bond stuff, but we have record levels of T-bill issuance. Again, that sounds boring. We're not issuing 10 years because there's no buyers, and we also want to take the price pressure off the 10-year treasury because when the yields spike, the interest rates get too high. But what the Fed is doing right now, what the Treasury Department is doing, 85% of the bonds issued are in T-bills, short duration bonds. Again, sounds boring, but as Luke Rowan and others have said, that's a sign that you're clearly in a debt crisis. And using T-bills to take the pressure off the 10-year is just it's the last desperate QE-like attempt before we go to direct QE. And I can't time when we're going to go to direct QE, but all of these mechanizations that go behind the scenes that are unnoticed by the financial media, and frankly, intentionally confusing for most investors, and intentionally so. But the BTFP program, the TGA, the reverse repo markets, the T-bill issuance, and now this little very quiet SRS ratios, these supplementary reserve ratios, these are all Wall Street tricks to create liquidity, to take pressure off of the Fed, but it is just QE by another name.